Good morning. My name's Paul Nicol, Managing Partner of GFM Wealth Advisory. A warm welcome to our GFM clients and our GFM guests this morning, joining us for a webinar from Munro Partners, where we're going to discuss two of Munro's funds, the Munro Global Growth Fund and the Munro Climate Change Fund. Now, in a slight change of plans, Nick Griffin, who is the founding partner and chief investment officer of Munro, he's unable to join us this morning. He's had to head overseas, but we're going to be ably supported, and we are very fortunate to have James Sinides, who is a partner at Munro and a portfolio manager, and to have Chow Ma, who is also a portfolio manager, join us on this morning's webinar. I'll formally introduce both James and Chow in a moment. Now, as is always the case with our webinars, it's important to let you know that these webinars are general in nature. They're not personal advice. Should you be seeking more information on anything that we discuss this morning, or if there is anything in relation to your personal circumstances that you wish to inquire, just contact our office and we will certainly get one of our advisors to make contact with you. So let me formally introduce James and Chow. So James, as I said, James is a partner and a portfolio manager at Munro Partners. James joined Munro in November of 2016, and he's responsible for championing stock ideas and managing these positions within the Munro portfolios. James previously worked as a portfolio manager and was based both here in Melbourne and in Edinburgh, and prior to joining Munro was a portfolio manager with K2. So good morning, James.
We really appreciate it. Nick sends his apologies today, but hopefully Chow and I can do a good job. So thank you very much for having us.
Pleasure. And I'll also introduce Chow. So Chow's also a portfolio manager at Munro Partners. Chow joined Munro early this year, so she started in 2023. She's also responsible for championing stock ideas and managing these positions within the Munro strategies. She manages the ideas within the Absolute Return Fund, the Long Only Fund and the Climate Fund. Prior to joining Munro, Chow was a portfolio manager at the Melbourne-based Cooper Investors and has spent well over a decade working in hedge funds in New York. So good morning, Chow.
Good morning. Good to be here.
Fantastic. Thanks for joining us. Okay, so look, let me start with you first and foremost, James. Can I focus on the Munro Global Growth Fund first and foremost? And if you wouldn't mind, could you just quickly give us a refresher on the strategy behind the Global Growth Fund and how it invests?
Yeah, thanks, Paul. So we're global growth investors, so we're investing outside of Australia. Predominantly today, that involves really investing in the US and Europe, to a lesser degree Asia as well. And really what we're looking for is structural growth parts of the economy. So that's things that aren't reliant on the economy to grow their earnings. And so what we've found with our process is it's best to focus on these sort of structural areas of interest that we look at. And so we've got here an example of the type of company that we would invest in, the type of area that we would invest in. That's on the left-hand side. That's really MasterCard and digital payments. So everyone on the call will be aware that there's probably very little cash today in their wallets, and they're really using their cards more and more. And that's been sort of a dynamic that's played out over the last sort of decade or two. And what that dynamic has meant is that the companies that enable that transition, that structural growth, have basically benefited in terms of their EPS growth or their earnings per share growth. And you can see MasterCard over the last sort of 15 or so years, the lighter of the two grey lines, its EPS growth has grown around about 15 to 20% on a very, very stable basis for a very, very long period of time. Obviously a small sort of or short disruption here through COVID when, obviously there was less overseas travel and less spending on that pursuit. But you can see over time, it's sort of really averaged that sort of 15 to 20% growth rate. And that's simply because you've had that sort of 2% market share shift over time from per annum over time from sort of physical cash to digital cash. So very strong sort of structural growth tailwind. And really what we look for is those structural growth tailwinds over and over and over again. And we look for the companies, and we spend all of our time really looking at the companies that are best placed to benefit from that. And sort of over the last 10, 15 years, that's really involved really investing in MasterCard and Visa as the, I suppose, the networks behind that sort of structural growth transition. The situation on the right-hand side, sort of just to juxtapose the two examples, we're really not invested in this type of company. So this is Bank of America, and this is a company that you can see, obviously, the grey line. You can make money on this stock, sort of trading this stock over time, but really the lighter grey line is really all over the place. And the reason it's all over the place is because it's very much a macro-linked company. So to have a good view of this company and to successfully invest in this company, you need to have a good understanding of a couple of factors that we have views on, but we don't necessarily have an edge on. So really, to get this stock and this grey line right, and the light grey line right, you need to have a view of how good the US macro is, what the interest rate cycle is doing, what financial markets are doing in terms of trading volumes, bad debts, et cetera, et cetera. We have views on all of those things, but there's nothing really structural in those views that can underpin a long-term investment case, as opposed to sort of the MasterCard example that I gave you, where this is a very, very simple long-term structural growth dynamic that actually we're still invested in today. Because although everyone knows about digital cash, physical cash to digital cash, the market has not been able to sort of adequately price that in, because the market keeps on believing that the company's growth, that 15 to 20% growth profile, is going to slow. And it doesn't slow because we're still only 50% through the total addressable market that the company has in front of it, because there's still 50% cash out there today, effectively. So that's why we continue to stay long an area like that. And that's an example, just one of sort of the 20 or so examples that we look at it as structural growth investors today. So a couple of the other areas we're investing in, I'm sure we'll talk about these, but as structural growth areas. So we're investing in sort of the climate change area. We obviously have the separate fund for that, but we invest in climate change across all of our products. Digital enterprise. So that's really a lot of software companies like Microsoft. We're not invested in Zoom, but Zoom is a type of company that sits in this sort of area of interest. High performance compute, which is a lot of these semiconductor companies, which are really the backbone of AI, and I'm sure we'll talk about that as well. We've got innovative health as well. This is a really good long-term structural growth area, because you have demographic tailwinds, but you also have a lot of innovation in healthcare as well, and so you get really strong structural growth stories in here, and we can talk about them as well if we have time. And then the last one's just e-commerce. I think we all know about e-commerce today, but again, e-commerce is still only sort of 20% or so penetrated in its main market, really in the US, and it's less than that elsewhere, including obviously down here in Australia. But that's another structural growth area that we remain invested in today. So that's a little bit of a flavour for how we sort of think about the world as structural growth investors, and how we sort of get down from 30,000 companies out there across the whole world to really sort of the best sort of 30 to 50 stocks that we want to look at and we want to invest in today.
Thanks, James. In addition to sort of owning between 30 to 50 growth stocks, I understand you also have some capital preservation tools that you use. Do you mind explaining that a little bit?
Yeah, thanks very much, Paul. I'll just quickly touch on these portfolio construction tools. So I think the main thing for us really is, although we do believe we have found, the MasterCard of digital payments and the Amazon of e-commerce, the reality is that when you're starting off in these areas, you do make mistakes. So how do you sort of rectify those mistakes? How do you sort of recognize when you're in eBay, not Amazon, or when you're in PayPal, although PayPal's been a good stock over a long period of time, when you're in PayPal versus MasterCard? MasterCard's outperformed PayPal of more recent times. And really, you do a lot of work on these type of companies and you really like the structural growth dynamic. So if you take PayPal, for example, we really like e-commerce and we really like digital payments. And PayPal really sort of sits across both of those because it's obviously more of a digital way of paying for digital e-commerce transactions. And so it's a company that historically we've liked, but has had trouble in more recent times. And we've done a lot of work on the company. We've met management many, many times. We've got very detailed models. You're talking about hours and hours of work. And really as analysts, you sometimes need that sort of team dynamic to sort of come over the top and tell you, hey, PayPal is not performing that well of recent times. The stock has corrected 20%. from the peak. And although we've made a lot of money on this stock, we really need to revisit this stock as a team to take the emotion out of your hands. And that's what we call these sort of stop loss triggers, these sort of 20% rules as the stock drops. And so PayPal's one that we've made hundreds of percent out of, but the stock had all of a sudden dropped 20%. And so Kieran, my colleague, was responsible for the stock, and we sat down as a team, and we actually triggered the stock out as a team. Kieran still liked the company, still liked its position, but as a team, we recognised that there was just emerging cracks in the story, and that was that e-commerce was slowing down, but also its place within the ecosystem was becoming threatened by effectively Apple Pay and other wallets that had sort of sprung up over time. And as a team, we decided, let's trigger that stock. And that stock actually fell, so I trigger and sell the stock. And that stock, although we sort of missed we could have sold sort of 20% or so higher, at least it stopped us from holding that stock all the way down. Like some other investors, that stock ended up correcting a total of 75% from its very peak. So, this is really the main mechanism that we use. And really what we're trying to accomplish from doing these sort of quite rigorous stop losses is actually the situation on the right-hand side of this slide. We have these sort of gold bars, which are very, very large winners over time, contributors to the fund. The grey bars are the losing contributors to the fund over the period of time that we've been running the fund. And you can see that the biggest loser is actually Uber, which is sort of a small, it's a loss. It's not great to take a loss, but you're sort of talking about 100 basis points of performance. Whereas on the winning side, you're sort of talking about the Microsoft position there, which is 8x the contribution. So we just feel like if you can limit the losses from any individual contributor, and run your winners, you're in a good position to generate good risk-adjusted returns. So that's what we sort of do from a stock to stock perspective, to try to stop ourselves from really falling in love with a company like a PayPal and riding it all the way up and then all the way back down again. On top of that, we also have a number of other portfolio construction tools that we use. So we can also short sell as well, which helps us sort of smooth returns, i.e. profiting from companies that might be declining in price. Because we structurally don't like them. So an example there is we're long Amazon and maybe short something like H&M historically, or we're long, maybe something in the electric vehicle space, and we're actually short something in the traditional internal combustion engine space. Those are sort of examples there. And then on top of that, we also run put options as well. So the way to think about them is basically like your home insurance. You hope that you don't have to use them, but from time to time, they can pay off in a very, very big way relative to the premium you're paying. So those are sort of the sort of three sort of key tools that we use on the downside.
Terrific, James. Now, if you don't mind me just going back to what you touched on before, and that's you guys identifying what you consider to be areas of interest. I'm keen just to drill into this a little bit more. Most fund managers, they'll show you where they're invested from a GIC sector perspective, but you guys very much focus in on these areas of interest. Can you talk to me about why you do this?
Yeah, thanks, Paul. Yeah, that's a good point. I mean, over the last sort of 16 years, Nick, the CIO, has really developed this way of sort of thinking about the world where we're really thinking about these sort of thematics or these areas of interest, as opposed to sort of just saying, okay, James, you're my guy on industrials in Europe, and go and look at that. And then Chow, you're my analyst on US industrials, or a better example maybe is looking at the retail space. James, you go and look at the luxury companies in Europe, and Chow, you go and look at the luxury companies in Hong Kong, listed in Hong Kong. What's sort of the point of that? They're all generally the tailwind for growth behind these stocks is generally not where they're listed or what sector they're placed into. The tailwind for the industrial companies is usually, well, today it's sort of green capex spending on grids and lighting in buildings and things like that. Or in luxury, it's really the Chinese consumer. Or historical, the last sort of 5 to 10 years, it's been really the Chinese consumer. So what's the point of me looking at French luxury and Chow looking at Hong Kong luxury? Better off for Chow just to look at the whole of luxury. And so that's the way we sort of try to organise the world. It really doesn't matter where you're listed or what sector you've been placed in by other agencies. It's really about that sort of structural growth dynamic behind it, be it climate change, the luxury consumer, or as we're calling it, the emerging consumer, etc. So that's how we've decided to organise the world, and we just find that works a lot better for us. To firstly find the companies that we want to look at, but then obviously also find the best company within that.
Okay. Well, this is a good segue to bring Chow into the conversation, because I look at these areas of interest. I've got to say the one that draws my eye straight away is high performance compute. And Chow, I think it's fair to say that of recent times, there's certainly been a significant focus on AI. And I think that significant focus has been driven recently by the launch of ChatGPT. So are you guys invested in in the area of interest, high performance compute in AI?
We are, and AI has really become a personal obsession of mine. Actually, it's probably been a personal obsession of mine since 2018. But it truly has become, one of the key cornerstones of the entire portfolio. And actually, I'll go through in a little bit more detail, but our exposure to AI actually extend even beyond high performance compute. But before we get into that, if I may, maybe I'll just take the investors along for a little walk back memory lane. If we just look back in the past 50 years, we really started with mainframe. Then we get into PC. We all remember how excited we are getting our PC and getting on the internet for the first time. Then is mobile, our iPhones, we love them. And really you cross over to the fourth era of computing, roughly around 2018. And the milestone is, and 2018 is the first time where machines, AKA artificial intelligence, actually generates more data than all the humans combined on the planet. And ever since then, the game has been taken completely away from the humans' hands, because it no longer matters how many times we search on Google or how many videos we view on YouTube. The real data, the bulk of the data, is now being generated by artificial intelligence. And then, of course, 5 years later, ChatGPT really showed the world how generative it could really be. You generate entire pieces of work and not just trying to optimize and help us with our search history, which is really what AI has been doing all along. So why does it matter to go back and look at these eras? So, the first thing I would say is every time we have a new era, the market becomes bigger. So if you just measure it in the number of units, which is not a perfect measurement, but it's a close enough proxy. The mainframe back in the 70s, the world never made more than tens of thousands of mainframe. And only the very large businesses need one. They're huge, they're very cumbersome, they take up a whole room. Nobody wants that. Era 2 in PC, we end up having hundreds of millions of PCs. So every household, every office is starting installing one. Then we talk about mobile, and the measurement get to billions. And then when we go to artificial intelligence combined with Internet of Things, this is going to be tens of billions of units being made. And this means sensors, chips, the whole shebang. So the market for IT, and that's a combination of both hardware and software, keep getting bigger with every single era. The second point, when you look at this, is every time you have lots of excitement, but when the dust settles, the cream flows to the top. The profit tend to be generated in every single era by just one or two companies at the top. So, when you think about PC and internet, Intel really run away with 70% of the market. When you look at mobile, Apple end up capturing about 75% of all the profit generated with smartphones. And we think with artificial intelligence and AI, it's not going to be different. So right now, the one big winner that's emerging is NVIDIA. And when you look inside an NVIDIA chip, what really stands out is NVIDIA right now captures about 80% of the profit coming from a GPU. Not the whole ecosystem, the cream flows to the top. So it's incredibly important in these big inflection points to invest with the winners that's going to keep winning more, that's going to generate more profit than even the previous era. So that's really what got us excited. And, with AI, we are just at the really starting point. So when you think about what people are using generative AI For at this point, by the way, it has been top of mind of every single CTO, CEO of not just IT companies, but really across the board. The clients for generative AI extend to normal business like retail, extends to consumer internet like Facebook, like every single internet company, including Munro, by the way, is everybody's trying to figure out how we can use generative AI better. So when you start thinking, when you put all these things together, it's really not going to be just a hardware game, which NVIDIA is running away with. We also think it's going to be a software game, where Microsoft right now is taking a very decisive lead. But we think this is a starting point. It's really exciting time to be a growth investor, because we do think you're going to create massive winners that's going to be way bigger than what we have seen in the world before.
So, Joe, how has Microsoft taken the lead in this area?
Yeah, so Microsoft is the biggest position for our main portfolio and the long only portfolio. And I just share one quote that Microsoft has shared with a group of investors a couple of weeks ago. They said, "Not since the 90s have we ever felt like we regained a lead over our competitors. We're back to being 5 years ahead of everybody else, and that's an incredible position to reclaim." So Microsoft invested with OpenAI very early. Microsoft is really spearheading at combining AI into everything they offer. So we talk about Azure, which is their cloud services. Almost 5,000 new clients have signed on to the Azure AI services, and that is the fastest ramp in any of the cloud product history. They are putting Copilot, which is the name they put on the AI assistant, into all their Office applications. So soon we will be having a meeting on Teams, like what we're doing right now, probably with Microsoft Teams instead of Zoom. And then we will have probably an AI assistant summarizing all the key points, and then automatically send out notes to all the meeting participants afterwards. So they are integrating these products incredibly fast and very proactively. And what they haven't announced, and this is what got us very excited, is the pricing of these products. So there's only been one telltale sign of how they're thinking about pricing, which is they have a software development tool called GitHub. And the GitHub Copilot version, which means the GitHub coming together with the OpenAI assistant, is being priced double the level of a normal subscription. And we think that that's probably a direction they would go with all the products across the Microsoft product suite. And you could think of the incredible potential there is if you think that the majority of your product portfolio today, potentially over the next few years, have the possibility of actually doubling in the price that you charge. So when you put it all together, we are incredibly focused on EPS for Microsoft. Really for years, Microsoft is a high single digit, 8 to 9% growth company. Now the consensus have moved on to 12, 13%. We think it could potentially be even higher once they really finalize the pricing details of these new products.
Yeah, so as you said before, Chow, that AI could have such a wide application across so many different industries. But I think one of the areas I'm keen to focus on, and you mentioned before, there'll be many winners and many losers. What about in the software application space? Have you guys identified any winners in this area with AI? And if so, potentially you could go through some examples?
Yeah, so in the software, again, we are literally on the first inning, and that's the perfect slide. Thank you, James. We are still on the first inning of AI. So, as of now, the hardware and infrastructure part, the winners are very clear. You have NVIDIA, you have TSMC, which we also invest in. You have the equipment makers such as Applied Materials. So that's on the hardware side. And then when they actually make this chip, they put it into the cloud providers. So Google, Amazon, Microsoft, these are not only, sort of the obvious structural winners, but they're already talking about how AI and application is already increasing and boosting incremental cloud demand. In terms of software, the two things I would say is we've only identified two so far, which is Microsoft and ServiceNow, but this is incredibly early. And if you really step back and take a really long-term view in all the major eras that I've shown you before in the previous slide, the first wave of money is being made by the hardware makers. But when you sort of extend out the timeline, the next 5 to 10 years, software makers as an ecosystem end up making multiples of what the hardware makers do. So we are really excited about it. We think it's a little bit too early to really decide on which software winners is going to be. And by the way, there's also going to be a large number of software losers. So as an industry, where the users of AI is at now is really trying to figure out how I can bring my own data and how do I get AI to organize this data better and help me make better decisions at this point. So, we'll be watching this very keenly. We will be updating you every couple of months, but software is definitely somewhere we're really excited about.
Terrific. And also in the area of high performance compute, I'm keen to talk about the semiconductors. Is this an area that you're exposed? And maybe you just could explain why semiconductors are so important.
Yeah, of course. So the world runs on chips. So any kind of data, the phones and PCs we're using to participate on this call is powered by chips. So, chips as, what we call the new oil for the new industrial era. And when you look at semiconductor companies, I'll just probably talk about two things that I think is structural. One is the level of complexity at making these semiconductors has really just become mind-boggling. Back in the mainframe era, on one chip, you might end up having a few thousand transistors, and that's already, wow, that's incredible. Now we're talking about between 50 to 100 billion transistors on one little chip. So the complexity is just mind-boggling. And then with the NVIDIA chip, the new catchword is called a chiplet. It's a very cute word. I love using it as much as I can. So a chiplet, actually, you can think of is a chunkier chip. And it's chunky because you actually stack different type of chips on top of each other, and you use incredibly sophisticated bonding material to bond them into one little chip. And they call it the 3D bonding. They call it, you're really just putting all sorts of components into one big chip. So when you think about on both complexity and dimension of manufacturing, the complexity has gone up so much. You end up with a very natural phenomenon that only very few number of companies can do this. So the second point of the structural change within semiconductor is in every single area that you are thinking about, there have been no more than two winners. In some particular areas, such as the lithography for the chips to actually print on the wafer, there's one winner, which is ASMC. So when you start thinking about all these subsegments of semiconductors, you're saying, okay, the underlying growth is coming your way because the AIs are just running on these chips and need a lot more of these chips to be powered. You don't have real competition. So the pricing pressure is no longer there. You have either monopoly or duopoly. So all these gross margins for these companies used to be maybe 10 to 20%. Now everybody has more than 40% gross margin. It just shows you how healthy the competition has been. And then, of course, these going to be global winners. So you don't have a winner in the US, a winner in Taiwan. You actually have one ginormous winner that really sort of support the entire industry. So we look up and down the supply chain of semiconductors. So we like the tools, which is ASML. We also invest with Applied Materials, but they are all the tools that go into the foundries, which is actually making the chips. But on top of that, you have the design of the chips, which is the Cadence and Synopsys of the world. And then, of course, you have AMD and NVIDIA that is designing and making these big sort of, AI-powered chiplets. So we go up and down the supply chain. Our total portfolio exposure for semiconductors is roughly 24%.
Wow.
And out of that, roughly 5 points is just on NVIDIA alone. And then sort of another, 18, 19% outside of NVIDIA up and down the semi supply chain. And just a very last little note on this is outside of NVIDIA, which is just such a incredibly unique story. All these companies are trading at incredibly reasonable multiples in terms of valuation. So TSMC is trading at quite 12 times price to earnings. ASML is a monopoly, so it's trading a little bit higher. And then, you were thinking about some of these other equipment makers, as Applied Materials I talk about, is still trading at a discount to the S&P overall. So we actually think that despite the big run and lots of hype that the media is just writing about, this group of companies could actually still have upside even on the valuation levels.
Thanks, Chow. I think we could talk about this all day, but I'll just shift there. That was really fascinating. So thank you. Look, I'll just shift the focus a little bit. James, I am keen to ask you a few questions about the macro environment, but I might just say that to the end of the webinar. I'll close out on our discussions around the Global Growth Fund, just talking to you about the performance of the fund in the last 12 months. You know, it would be remiss of me not to ask. It wasn't an easy period for you guys over the last 12 months. So I'm keen to talk about what may have impacted returns, but more importantly, I'm also very keen to focus on what you feel like the return environment or the investment opportunity in the upcoming period is.
Yeah, thanks, Paul. Look, I think in 2022, the big sort of shock to markets, and particularly for growth investors, is the movement in interest rates. So you can see here, I mean, apologies, this is a bit of a busy slide, but basically what it's telling you is that the Fed and everyone else, including ourselves, were caught off sides with just the veracity at which rates moved up. I think most people, like ourselves, probably expected rates to be very low for a very, very long period of time. The good news is that now that that's actually started to peak and they're actually coming back down again. And the reason that's important, and the reason that getting back to sort of that 2 to 3% interest rate level sort of terminal rate is important, is because as growth investors, a lot of our performance or a lot of our earnings per share is actually off into the future because we're growing so fast for such a long period of time. You're basically looking, as Chow's talking about, you're looking about collecting your earnings over sort of a period of 10 to 20 years. And you have to actually discount that back and sort of, not to get too wonky, but your discount rate actually really matters in terms of your short-term valuation. It's not going to stop your stock from basically earning all of that money over that sort of 10 to 20 year period. But on a short-term basis, it can actually have a quite big impact on the valuation that you want to pay for it if you're discounting that sort of future earning streams back at today's prevailing interest rate. And that's why this sort of very violent sort of inflationary environment that we've had and this very violent move in interest rates has been so painful for growth investors. It's not that we've got these sort of things wrong in terms of our earnings expectations for these companies. In fact, most of them are on track. They're not actually under delivering, or there's no sort of cracks in any of their fundamental stories. It's just that short-term valuation reset. The good news is, last year everyone was talking about, okay, what's it going to take to kill this inflation? Are we in some sort of death spiral here where rates are going to have to go back to sort of, the 1980s type of level back here? What sort of impact is that going to have on the valuation of these growth stocks? So that would be really, really painful. The good news is that now we're basically past that point. So we do feel that inflation's coming back down quite, maybe not dramatically, but quite steadily. We do feel like we're in a very high debt environment, and we do feel like rates are going to come back into this period. So that's into this sort of 2 to 3 range. That's really, really good for growth investors, because it basically means that our discount rate is known, and that we can basically go back to valuing these stocks appropriately as we sort of previously had. Based on that sort of view that rates are not going to get out of control here. And we're quite confident that that's the case, because we do see that the economy is going to slow here. We don't know exactly how much it's going to slow, but we do think it's going to slow. And so we can get back to basically saying, okay, our valuation multiples are appropriate. As Chow was sort of talking about, some of those valuation multiples in the AI space, we don't think that they're stretched. There's obviously some areas of froth in the market, but most of the market's well valued for a 2 to 3% interest rate world. Then we can get back to basically following these great sort of structural growth companies. And what we're just showing here is the earnings per share expectation or growth for the companies over a long period of time. And you can see the other thing that happened in 2022 is some of these areas of interest did actually go through a bit of a slowdown or a bit of a correction cycle. And so if I just take, for example, I think the best example is Google, and I apologize, I hope this is not too hard to read for people, but Google's this sort of purple color here. You can see it has actually gone through a period over the last 2 years where it has been basically tracking sideways a little bit. That's partly because the ad market has slowed down a little bit, sort of 2022, 2023. and it obviously, that's primarily the main driver of its earnings today is ads on Google and also on YouTube. Obviously as a big cloud business, number 3 player, that's very exciting. But today this is what's been holding Google back. And the other thing is that a lot of these companies have put a lot of investment in for the future. And so they've probably actually overhired. And now they're actually correcting that. And you're sort of seeing Facebook rationalize its workforce by around 20% or so. Google, I think, is about 8%. They're just sort of right-sizing the businesses. But at the same time, you're sort of coming through this sort of difficult sort of 12 to 18 months of basically of earnings. And you can actually see, it's not much here, but you can actually see the companies out now starting to grow again. You can see that with ASML, similar. So it's gone through a 1 year sort of inventory correction. Everyone can see like this huge AI application for semiconductors and semiconductor capital equipment and tools, which Chow just sort of talked about. But there has been this period of about 12 months where you have had this inventory correction. And now they've worked through that, and then they're growing again. So all else being equal, the share prices will now start to follow these companies higher, these earnings per share growth of these companies higher. As I showed here, over the long term, so right back to the very, very start, sorry, hopefully I can use my mouse correctly. Over the long term, the share price, i.e. the dark grey line, will follow the earnings per share of the company. There are periods where it becomes detached because interest rates go up or interest rates go down. And so the multiple goes up or the multiple goes down, i.e. the PE multiple goes up or PE multiple goes down. But over a long period of time, it's the earnings per share that actually drives the company. And so long as you have this correct, and these are 5 examples of ones that we do think are correct, that are going to go higher, the share prices will actually follow that. And the good news is that these earnings per share lines are starting to move higher again.
Terrific. So James, much earlier in this discussion, we spoke about areas of interest, and one of the areas of interest in the Munro Global Growth Fund was climate change, and then you specifically run a climate change fund. So can you just talk to me about the philosophy behind having a fund that specifically invests in climate change?
Yeah. Thanks for that. Yeah, climate is an area actually that we've been looking at for sort of over a decade, prior to the GFC actually. And we used to invest in wind turbine companies, solar companies, and so forth. And we sort of went through a period post the GFC where sort of the brakes were on, and this sort of priority of climate change and climate transition, energy transition, sort of got put on the back burner a little bit. And what we found sort of 3-4 years ago now is it started to come back up to the surface. And it wasn't so much sort of the Biden administration coming in and sort of Trump going out and Australia signing up to net zero and these sort of things. It was actually more the corporates that we noticed started to talk about this more and more. And if I just skip over this one for a moment, just go to this page here. Yeah, of course, the governments and what they're doing is very important as well, because they set a lot of the regulatory rules and provide a lot of the tax credits and so forth. But what we did notice back in 2018-19, it doesn't look like much on this slide, but a lot of these corporates start to sign up to the science-based targets. There's companies like Apple sort of saying we're going to be net zero. So we're not going to rely on sort of fossil fuels anymore. And we're going to tell all of our suppliers, TSMC, et cetera, in Taiwan, to basically green up their footprints as well. It was Microsoft sort of saying, not only are we going to be net zero, but we're actually going to take all the carbon that we've ever produced as a company back out of the atmosphere. So these were sort of big, sort of game-changing statements from very big companies with very big supply chains as well. So we knew that there had to be real money that was about to follow this. At the same time, we sort of had all the investors starting to sign up to sort of ESG targets themselves and sort of work hand in hand with the corporates to sort of say, okay, great, you got a 2050 target to be net zero, or you might be a 2030, or in the case of sort of a tech company, where it's probably easier to decarbonize the operations, it might even be 2025. But what are you doing today? What are you doing this quarter or next quarter? Because as we all know, by 2050, all of the people running these companies, they're going to be long gone. So they're setting targets for someone else to basically hit. What was important was some of these other groups that sort of came along, like the Climate Action 100, that sort of then started going in to see the CEOs and chairmen of these companies and saying, last quarter you told us you were going to you were going to reconfigure your building with, smart lighting. So did you do that? Okay, you did that. Great, fantastic. Or you didn't do that. Why? What? Why not? Or you said you were going to place orders for X amount of electric, vehicles, and did you do that basically this quarter? And so we started to notice that the money was actually going to start to hit, or going to hit much sooner than we thought, because these companies had these targets. So as structural growth investors, that's very exciting, because that's an area of structural growth that the companies are going to invest for on a longer term basis. It's at least a 3 to 5 year spending tailwind, and that's really what we look for. And then really it's about following the money. Okay, so where's this money going to end up, and how big is the pile of money? So I just read some stats the other day, much higher than this. But Goldman Sachs, probably the preeminent investment bank, they're sort of talking about 50 trillion of spending to decarbonise by 2050. Bank of America is actually significantly higher than that number. There's others out there significantly higher, more like 130, 150 trillion. It's huge amounts of money. Just to put that in perspective, like the whole Australian share market's about $1 trillion in terms of market cap. So you're talking about huge dollars here. Now, where's that money going to end up is the next question. So is it all going to be in passenger EVs? No, clearly not. The European Investment Bank thinks that that's actually going to be about 18% of the spend. Is it going to end up all in renewables? 18% as well, is what the European Investment Bank is saying. Actually, the biggest piece is actually this energy efficiency piece, which is 24% of the spending. And so that's actually quite interesting, because you probably wouldn't really think of that, but that's really retrofitting buildings and things like that, heating and cooling, bog standard sort of industrial companies that you never really thought about, all of a sudden have this structural growth tailwind, and all of a sudden they're taking orders all over the place, not for heating and cooling systems that are broken down, but actually people saying we need to get rid of our old system because we've signed up for net zero and we need to be a 5-star building. And so that's the sort of tailwinds that we're sort of looking at. It doesn't just have to be the sort of sexiest electric vehicle company out there, or the company with the best wind turbine. Of course, we're interested in all of them, but it can be sort of old school industries which you never thought about in the past, like insulation or heating and cooling, that also have this new tailwind for growth behind them. And the way we're sort of categorizing these in a sort of more easy to digest fashion is just across these sort of 4 subsegments.
Yep.
So this 50 trillion of spend we think is equally roughly divided across these 4 subsegments on the right hand side. And it's clean energy. So that's your companies that are involved in building wind farms, solar farms, pairing them with batteries, etc. Building out the grid as well. So the electrical grid needs to be replaced as well, because all of a sudden you're not getting all of your power from a coal plant somewhere and transferring it to a city. You're trying to get your power from a wind corridor somewhere, or a state with a lot of sun. We don't probably have that problem here, but you do in Europe and obviously in the US, and transferring that sun somewhere else, where the population is. And so it's these type of companies. So it's companies like Vestas that does wind turbines. RW that does wind turbines. NextEra does a lot of solar, develops a lot of wind. Enphase, which is in the solar supply chain. Constellation as well, which is more on the nuclear side of things, actually. So that's sort of the clean energy piece of the puzzle. Clean transport's obviously another big piece. That's 18%. We're not actually invested in Tesla for the broad funds that we run today. We've got a small position in Tesla for the climate funds, but we've actually more preferred to play the inflection in EV penetration through the battery companies like Samsung SDI, which is not Samsung, the mobile phone company. It's a related company in Korea, but it's actually a specifically listed company that just does batteries, or predominantly does batteries, as well as companies like onsemi, which is in the semiconductor side, which actually powers the drive of the car, basically converting the battery to basically effectively the motor to run the car. So they call it power semi. So we sort of prefer to pay the weapons manufacturers in the war here, which is Samsung, SDI, and on, or the picks and shovels, the other way to put it, as opposed to sort of picking, is it going to be Tesla, or is it going to be Ford, or someone completely out of left field like Rivian or something like that. We do like Tesla the most of the EV space, and that's why we own that in the climate fund specifically, but not in our broader funds. But yeah, we do prefer the sort of the picks and the shovels. And so I'll be quick here. The energy efficiency we really like, as I sort of say, it's companies like Kingspan, which is an Irish insulation company. That's just, think about going to an architect and saying, hey, you shouldn't build with concrete. You should actually build with our insulation boards and panels because you get X amount of heating and cooling savings, and it's so much better for the planet, etc. The last piece is just circular economy. And this is a bit of a catch-all, but it's everything from waste disposal, water management, agricultural, land conservation, etc. That's companies like Waste Management, which is just an old school American company. Anybody that has been to America, it's the first thing that hits you. It's the amount of trash.
Yeah.
When you go and order some food and it's a polystyrene cup or whatever, and trash everywhere, or a lot of trash and packaging. This is a great business. There's three main players in the market. It's their traditional business is really strong, and they've got landfills that are not replicable because no one wants a new landfill built. But all of a sudden they have this old school company that's been around for decades, all of a sudden has this new area of growth, which is basically recycling, automation and recycling, which they're going to make a lot of money out of by basically taking the trash, sorting it out, and basically giving the plastic back to Coke and Pepsi, because they've, as I sort of said, they've signed up to these ESG goals, environmental social governance goals. Same with Starbucks, etc. So these are the type of companies on the recycling side that are going to be good clients for them. And then on the methane side and the capturing of the gas off the landfill, this is just something that's just not in people's expectations. It's something that, if you talk to the companies, they talk about, but the Wall Street analysts don't put into the numbers because it's a new business line for them. And we think this is actually up to 15% earnings upside for the company, for a company that's been around for decades, just from capturing the methane off the landfill and putting it back into the pipes. And they can already do that today. They already do it in their own trucks to run their own truck fleet. It's called renewable natural gas. They're actually got these plans in place to now actually invest in this and actually put it back into the gas pipelines and sell it off to customers. And customers are desperate for this because it burns so much more efficiently. And back to sort of this slide that I showed you, the customers have all signed up for these ambitions as well. So, sorry, I probably went on way too long there, but there's plenty of different angles in climate. And climate's about 10% of the Munro Global Growth Fund as an area, which is invested across these type of stocks. But then we obviously have that separate climate fund, which invests in these stocks as well. But we've got a few others as well, like Vestas, the wind company that I sort of spoke about, is not in the big fund, but it's in climate fund, Tesla, etc. So there's a few more ideas on it's just a more broad fund.
That was a great explanation, James, because what I gathered from that is the investment opportunity in decarbonisation, which started as a ripple, is fast turning into a tidal wave. So I really appreciate the explanation. It's a question of curiosity more than anything. Nvidia is clearly the hot stock of the moment, and Chow spoke a little bit about it before. It's in your Munro Global Growth Fund, but it's also in the Climate Change Fund, and it's in the area of clean energy. So I'm really keen to understand how a stock like Nvidia could be considered a clean energy stock or business.
Yeah, it's a good question. I actually don't have a slide on Nvidia as it pertains into the climate era, but basically, of the electricity usage in the world, about 2% of it's used in the data center. And you can sort of see where I'm going here. Data centers growing very, very quickly. And so that's going to be a serious, basically, source of emissions. Now, the people that run the data centers are very cautious on electricity usage because it obviously costs them money. But also they've got their own carbon issues as well. And so part of the Nvidia story is actually going from CPUs to GPUs, which are basically more efficient from a compute side of things, but also from an energy intensity side of things as well. And so that's how sort of Nvidia directly plays into making the data center more efficient. And as I say, it's 2% of electricity. On top of that, we think there's probably other angles where they are assisting. So, if you sort of if you're talking to the company, they're sort of talking about, their case studies that they use in terms of what they do with their clients that can make their clients more efficient. It's basically setting up their factories and plant more efficiently. And so they sort of talk about, working with BMW to basically design the plant before actually having to build it. And so you can imagine that there's a lot of energy efficiency sort of gains on the back of just having this compute power as well. Chow, would you add anything to that, just on the sort of more the applications side of things?
Yeah, I mean, I think you're spot on. I think the 2% of power that is being consumed in data centers, when you're thinking about the world of accelerated computing, that's going to go up multiples. So without NVIDIA helping the energy efficiency on accelerating compute, as we get to the next era of artificial intelligence compute, data centers could easily be a high single digit, so 9 to 10% of the total global energy consumption. And you can see the incremental power and the pressure it's going to put on the grid. So, one really fascinating example is the fastest NVIDIA superchip powered computing today is 6 times more energy efficient than a CPU powered supercomputer with the same computing power. So you could think about, the world basically cannot really have sustainable compute the way that we're thinking about it without having a company like NVIDIA to help along the way.
Fantastic. Thanks for that explanation. Okay, look, we're nearly out of time. So I guess the last thing that I want to ask is more a macro question. This isn't an easy environment to be an investor at the moment, albeit market returns, particularly since the start of the year in global markets, have been strong. How are Munro feeling about the investment environment going forward with a macro view?
Yeah, thanks, Paul. I can take that one. So really, 2022 was a difficult year, and we did raise a lot of cash because we were wrong about interest rates in 2022. We did expect rates to stay lower for longer coming out of COVID. And as I sort of touched on earlier, that really did surprise us. So we did feel like, as growth investors, we did have to move away from some of those higher multiple growth stocks. So i.e. growth stocks that have traded on really high PEs, which we do like because you can see such massive growth into the future. But we did have to be quite cautious on those positions. So even we talked a lot today about high performance compute. And so what did that mean for what we did in our high performance compute portion of our portfolio? That meant that maybe, and it seems silly now that NVIDIA's really just taken off so much, but NVIDIA always traded at a higher PE multiple, sort of call it like the 30 to say 60 PE times range, because it's got such massive growth into the future. Whereas something like, as Chow was saying, like an AMAT or an ASML might trade at 20 times. And so when you've got those rates going up so violently through the year, NVIDIA's share price naturally comes under more short-term pressure because that multiple is coming down. Whereas ASML can hold its multiple for longer because it's more profitable today, or it's getting more of its growth today, as opposed to out into the future, and you sort of don't have to discount that growth back quite as far. It's sort of just this sort of mathematical way that it works with discount rates. The good news today is that sort of heading into 2023, we do have a very strong view internally that rates have now peaked and are coming down, and inflation has now peaked and is coming down. And the reason we have that view is because we talk to all the companies and they're all telling us that the labor situation is sorted out. The supply chains are better. They can get access to new trucks, whatever it might be. They can get access to shipping containers. There's all these disruptions coming out of COVID that sort of create this perfect storm. We do feel that that's now come down. And that, really importantly for us as growth investors, is that this long-term rates have peaked. So that's a tick. The other thing that happens is in these bear markets, they usually last about 12 months. And now this bear market actually started in January 2022. And so it's actually now coming up to 18 months. And so that's actually a tick as well. And so that's important, because the longer that time goes on, the more time people have to readjust. I talked about how sort of Google readjusted for a harder environment with their cost base. Companies have time to readjust. The market has more time to readjust its estimates and expectations. The third piece is the earnings estimates need to come down. Now that to us is still, we've got here as a cross. They have come down a little bit, but maybe they're still a little bit high in some parts of the market. But as I say, really as growth investors, although sort of Wall Street analysts haven't brought down their numbers probably enough to sort of reflect this slowdown, we do feel like these core growth areas are actually now starting to grow again. And so as growth estimates come down for the market, that might sort of impact sort of your older sort of bog standard industrial companies, oil companies, etc., more cyclical companies like financials or retailers or something like that. But these real sort of structural growth companies, we now actually think have been through the worst of it, now starting to grow again. So from a macro perspective, we're actually quite comfortable and quite positive on the outlook. Despite having that sort of, as I sort of showed there, and sorry for jumping around, despite having that sort of, official cross or, a bit of a question mark, we do feel like, at least for the growth stocks, because of this dynamic, you've now seen that, and you can actually probably tick that for the growth companies.
Interesting. Okay, James, Chow, thank you. We're out of time. I just want to, on behalf of the GFM team, our GFM clients and the guests that have joined this morning's webinar, I want to thank you both for your generosity of time, and I thought both of your explanations to the questions were just fantastic. So thank you both.
No, thank you.
Okay,
Thanks,
Shayla.
Paul. Thanks,
Take care.
everyone.
Bye.
Take care.
Thanks, everyone.
Bye.